Hello and welcome to the Property Roundup here on iPropertyRadio with myself, Carol Tallon, the show where we chat to industry experts to get a view on activity on the ground and to learn about new trends emerging. This show is sponsored by daft.ie, Ireland's most visited property website. Today, I'm delighted to be joined by Margaret Barrett, Managing Director of Mortgage Navigators. Margaret, you're very welcome. Thank you for joining me today.
Carol, thanks a million for the invite on.
Margaret, the start of the year always feels I'm one of these people, I put a lot of store into new start, new year, fresh thinking, new habits, new financial habits.
Yeah.
And a conversation was going on within our household about getting finances in order. So it's a really good time for me to be talking to you. And I want to really help and make this as informative as possible for anybody who might be thinking of buying their
Yeah.
first home, potentially self-building, or maybe even trading up or down, or getting involved indeed in investment. But the buy-to-let market, that seems to be few and far between at the moment. But before we start, Margaret, you might just give us an overview of what's happening in the mortgage market in Ireland as we start into 2024.
Yeah, very good, Carol. Thanks very much. And you're dead right. I'm sure there's people that have moved home into their family homes over Christmas and said, will I move back home? Won't I move back home? Will I buy? Won't I buy? So it's absolutely a great time. And we always see a massive spike in January of customers starting that mortgage process or certainly starting that initial conversation. And I suppose, the good news is that we're starting 2024 with the news that the European Central Bank are re-looking at their interest rates, and interest rates potentially are going to decrease. And that's a good news story because this time last year we were in the height of rate hike increases and saw a raft of rates increasing over the last 12 to 18 months. Now they've been stable for the last, 4 or 5 months, which is really, really positive. And, hopefully by the back end of next year or the back end of this year that we'll see potential interest rate decreases. So it's a good time. It's a good news story. We're also starting to see supply coming back into the Irish market. Probably not at the rate we'd like, Carol. We'll finish. I think we finished 2023 with over 30,000 units coming to the market. That's up year on year. But what I suppose the good news story is that we can see a good pipeline of properties to come to market. And I suppose there's a mixture of these properties. There's the standard new build property. But furthermore, we're seeing a lot of new affordable houses coming to market, more social housing, and certainly more cost rental properties coming to the market. So that's all positive news. And I suppose to underscore that again, the banks are open for business, and they are lending, and we're seeing new lenders coming into the Irish mortgage market as well. So all positive signs. And I suppose, look, that's coming from a low threshold, unfortunately, but it's going certainly in the right direction. So I think 2024, 2025 are going to be good years from a supply and mortgage perspective, Carol.
That's a great note to open not just the show but the new year on. But I suppose first I want to focus on interest rates. So yes, we've seen not just huge increases but successive increases in 2023, and yet surprisingly, first-time buyers were getting mortgage approval and using their mortgage approval en masse.
Yeah.
So
Yeah.
with interest rates rising or set to come back in 2024, and obviously nobody has a crystal ball here, but it's certainly that's the indication that we have. Is that actually a good news story? Because I suppose I'm conscious that over the last year and 18 months, when we had price increases or rate increases, house prices didn't drop the way we thought they would. We had a little tiny period of a drop, and then they started to stabilize and are now starting to
Yeah.
increase again. Now that's quite dysfunctional, that house
It is.
prices, particularly for first-time buyers and mortgaged home buyers,
Yeah.
would continue to even hold steady or increase in the face of rising interest rates.
Yeah.
And the fact that we're seeing a shift in the interest rates, but the demand for housing is still there. The supply, while you've outlined kind of reasons to be hopeful about the pipeline, right now demand still is well
It
outstripping
is.
supply.
Yeah.
Can we consider interest rates to be a good news story in that context?
I think we can. And I suppose what we've seen is that, and look, 67% of our market is made up of first-time buyers, so we can just speak about those cohort of people particularly. I suppose they have proven they have the affordability because they're caught in a rental market that's also dysfunctional, Carol. And the average rental outgoing in Dublin is over €2,000. And I suppose if you were to purchase that property and mortgage it, you'd have a mortgage repayment of €1,400 per month. So they have the affordability and the proven affordability. But the problem we have in Ireland, and you've hit the nail on the head, is that we have such a pent-up demand for property that hasn't been addressed for over a decade. So whilst we're bringing over 30,000 units to the Irish market in properties, we probably need somewhere around the 50,000. So that demand is, whilst we know it's there, and unfortunately it's not being treated as an emergency situation. And look, in fairness, the government have brought in lots of new measures to, I suppose, help the pipeline flow and make it that bit faster from planning to end result of a new property turning a key in it. We still have, if we looked at our population, we have 86,000 people aged between 29 and 35 living at home with their parents. And that is in its own right dysfunctional. We now know the average age of a mortgage applicant is 35. And if we to look back into 2004, so like just scroll back 20 years ago, that cohort of people of 35 plus accounted for 17% of our mortgage market and our property purchase. So unfortunately, we have created a whirlwind of problems. So I suppose getting that interest rate decreased is absolutely a positive. You know what I mean by that? Absolutely. Yeah. Now, we're coming from an all-time low where the ECB was at 0%. So that's not sustainable either. You know what I mean? So back 4 or 5 years ago, we had interest rates of 1.95%. We now have interest rates of 3.65%. We, I suppose, are lucky in a way, if you can say this, a little bit tongue-in-cheek, that the Irish banks didn't pass on the full 10 rate hikes that the European Central Bank issued. So we've probably only seen 50% of the rate hikes. So in my opinion, I would suspect we'll see the Irish banks slow to pass on the rate reductions. So we may still have 3.65 for the vast majority of 2024, but you would be hopeful that something will come at the back end of the year and we'll get down to the 3.4, 3.2% and get that a little bit closer to the 3%.
I suppose the important thing there is that it's moving in the right direction for people who are existing homeowners and for those who are potentially thinking of buying in 2024. You know, I like that you acknowledge that a lot of the problems we have in the property market today have been created. They didn't just happen. You know, successive policies, a lost decade of home building. You know, and I think it's really important that we do position it as actually these are problems that you know, we created, or we certainly fed into across industry and across policymakers. And I think it's really important that we position it like that so we don't continue to make the same mistakes again. And you can see a little element of that kind of creeping back in. So, you know, it's something that I think is really important for us to get right. You talked about cost rental, and there have been a number of really good state schemes. Cost rental, I think, has been maybe designed with lifetime renters in mind, but actually there's a lot of very savvy people who are applying for cost rental, and you know, it's still being delivered through a bit of a lottery system essentially. So it's not accessible to all, but it will become more accessible as more cost rental homes come on stream. But are you meeting potential home buyers who are maybe using cost rental as almost a savings mechanism?
Well, they could, and you could see why they potentially would go down that line. Look, I think I spoke at the Property Summit, Carol, and I noted this point as well, is that we're now all eating out of the one pot, right? Okay, so you have the private, so a new estate goes to market with 300 houses in it. The potential now is that, you know, you'll have social, you'll have affordable, you'll have cost rental, all inside in that new estate, right? Okay, so often I spoke to a customer last week and she was living abroad, hoping to come back, and she said to me, "Who's my biggest competitor?" And unfortunately, her biggest competitor is now the government. You know what I mean? And it's because we have the private developer pushing the properties to market, but everyone is lining up behind it to get the property. And I think that's the problem we've created. And if we to look back to the Celtic Tiger boom of property in 2006, we had a population of 4.1 million, and we delivered over 55,000 properties. We now have a population of 5.1 million, and we're delivering 29,000 or 30,000 properties. So it's not matching. You know what I mean by that? Yeah. So we've created this whirlwind of problems, and okay, we're now trying to get out of it, when the government, in fairness, have come with very good schemes, to help people to get on that property ladder. But I suppose the government owning an equity share in your property may not be the answer. You know what I mean by that? It gets the person on the ladder, but is it creating a problem for down the road? You'd have to wonder.
Margaret, that is such a powerful point you made there in terms of home buyers in the marketplace, that their main competitor is the government. I mean, I certainly in the last 25 years don't ever recall a scenario like that. And I know in the last number of years we were looking at approved housing bodies coming in at the time. Buy-to-let investors maybe were still purchasing to some extent, although we're not seeing that anymore. You might just give us a breakdown of the people that you're talking to. So you mentioned 67% of your current applicants are first-time buyers. Yeah. Are the balance those kind of moving mortgages? Are they trading up or down, or are you seeing many buy-to-lets?
So we're seeing very few buy-to-lets. We'll start at the bottom of the pile. We're seeing very, very few buy-to-lets. We are seeing a number of customers living abroad that had immigrated over the last number of years trying to return. So we're certainly seeing I suppose, an increased level of conversations happening, I suppose. You know what I mean by that? I suppose projects are kind of limited, Carol, so it might be somewhat of a deterrent from a property perspective. We're certainly we're seeing a lot of customers in rural areas trying to self-build their property and getting caught, I suppose, in the whole planning regulations that are coming with that. And then we're seeing a cohort of customers that are caught in the rental market and be it the landlord is selling or the property is no longer suitable and they're trying to buy that first home. And I suppose, unfortunately for that cohort of customers, because they're paying such high rental outgoings, it has prevented them from saving that elusive 10% deposit. So they're kind of nearly forced into purchasing that 3-bed semi-detached that they can get the Help to Buy scheme on. And that's the cohort. And I suppose we know that over 57,000 people applied for a mortgage last year, and sorry, that figure is wrong. I think over 50,000 people applied for a mortgage last year, and 47 were homed, right? Okay, so 47,000 were homed. So they're getting through the pipeline, but it's not fast. That's the key. And I suppose if I to send one message out to anyone that's anyway thinking of buying a property in the next 12 to 18 months, is that you have to be prepared, and be it mortgage prepared, location prepared, or property prepared, but you have to start, because it's not a fast process. You can be guaranteed if an estate goes up with the billboard saying 300 houses coming in 2024, you can be guaranteed that probably 50% of them are now bought off plan. So we're back to that era, you know what I mean, which I'm not saying is good. You know what I mean? I'm not promoting that at all, but we are unfortunately back to that era where people are lining up for properties, and it's not that property is ticking all the boxes. It's that it's actually pretty much, Carol, a roof over their heads.
That is such an awful scenario to be in. I think it's maybe even nearly 4 years since we saw the first instance post-crash of home buyers queuing in their cars overnight around new developments. And I think at that point it was maybe in Limerick. And, one of the things, you're right when you identify the trend, it's not that these people are rushing to buy their dream home. They're rushing to get out of Ireland's even more dysfunctional rental market.
Yeah.
Margaret, can you explain something to me from kind of, I suppose, somebody who understands the mortgage application side? You know, a number of years ago, we talked about the importance of mortgage applicants being assessed based on showing affordability, because they're maintaining these incredibly high rents, sometimes for not just 3, 4, 5 years, but 13, 14, 15 years. And there has been mixed commentary. The banks tend to come out and say, no, we do count that as that you can meet the repayments, but that obviously it's eating into the capacity to save for a deposit. So can we just break down those two separate things? So rent that's being paid, whether it's over years or in some cases decades now, because that's where we've moved to in this housing crisis, is that absolutely taken as affordability?
Yes. So there's I suppose, three assessments if you to really whittle it down, right? Okay, so there's the loan to income. So that is what your gross salary is as a first-time buyer multiplied by 4, as a mover multiplied by 3.5. Two applicants, it's combined. Okay, so that's the first one. So that tells us the maximum amount of money you can borrow. The second, and it's probably the most important assessment, Carol, is called proven repayment ability or demonstrated repayment ability. And that is pretty much catching the mortgage amount that you're going to be paying every month. Most banks are now stress testing for 2%, and probably rightly so, given what we've just come out of rate hikes. So you have to pass the stress test. What they take to show that proven repayment ability is rent is number one, but it has to come out of your bank account. So you have to bear in mind that we're assessing your salary account or current account and savings account over the previous 6 months or the 6 months prior to application. And we're looking for that mortgage repayment, stressed mortgage repayment over that 6 months. So if you're paying €2,000 per month for your rental outgoing, and we can see it going out on the 25th of every month, that is proven repayment ability. So that is telling us that you can pay that amount of money towards the mortgage repayment. If the mortgage repayment is stressed, and it's stressed at, let's say, €2,500, and you're paying your 2,200 in rent, we're now looking for €300, and that's where the regular savings comes in. And there is no way past that, Carol. I suppose if I had to call out the number one reason applications will get a decline, it's for demonstrated repayment ability or proven repayment ability. And there was a time banks might look at 80%, you know what I mean, that, prior to the rate hikes from the ECB, there was a time, banks would say, look, if you can prove 80% of the demonstrated repayment ability, we'd be happy to assess it. It is now 100%, and often the case, it's 100% plus the stress. So
yeah, but that makes sense, doesn't it? Because actually then we are protecting the next generation of home buyers.
Absolutely. And like I'd always say to customers, okay, this is a box ticking exercise. If you're not doing it now, we can put a plan in place to do it for the next 6 months. But the reality is that this is a long-term financial commitment. So it's fine to get the mortgage today, but circumstances can change. So it needs to be your mortgage repayment, I suppose, to put it in one description, it needs to be comfortable on your worst month. Right. So there's no point it being fine. You can do it for the bank, get approved, buy the house, and then your circumstances change. Your family might grow, children might come along, there might be unpaid, maternity leave or paternity leave, so it needs to be comfortable, as I say, on your worst month. To ensure that it's not financially stressing you. So it's fine to please the bank, you know what I mean? That's satisfying the Central Bank of Ireland if they were ever audited. But in reality, it needs to be really comfortable.
Margaret, I love that. Actually, I think that's the way we need to be speaking to people who are considering getting a mortgage. When we talk about proven repayment capacity, it needs to be comfortable in your worst month. That's that's a way that I think people can understand, because they understand the cash flow of their year, and some months are better than others, even if you're in a salaried position. So I think that's really important. Okay, so you've got your loan to income, you've got your proven repayment capacity. So what's the third big consideration?
So the next one then that, and I suppose customers can't predict this. So this is where you need the broker, you need the bank to help you. So we have to look at your debt service ratio, and we have to look at your net disposable income. And I suppose very jargon-free debt service ratio needs to be under 50%. So that's your gross monthly income, and when you pay all your debts and your obligations, that you still have 50% left over. So banks like to see at least under 50%. Some banks, Carol, would actually go as far as saying they'd like to see it under 40. Again, it goes back to my point, it needs to be comfortable. You know what I mean? Net disposable income then is actually your take-home pay. So we'll say your take-home pay, what you've left over every month, and how much you can service your debt. So your mortgage, your car loans. If you have children, there's a deduction taken off per child every month. And those two, obviously have to pass assessment. If that all passes, you are going to get approved. And it's as simple as that. You know what I mean? There is nothing else that you need to satisfy the bank. Okay, we might look at your employment. You know what I mean? If you're, let's say, a professional contractor, which we do deal an awful lot with, that there's longevity left in your contract, that we can prove that your income is sustainable. So if you're self-employed, the same, you know what I mean? We're looking back over the last 2 to 3 years. If you're PAYE, full-time permanent, the box is ticked. You know what I mean? So your salary is assessed as is. Obviously, we're looking at your bank accounts then, I suppose, from a side note assessment, we're looking to make sure that you're operating inside the terms and conditions, that there is, no major gambling going on. And I know that's the one that an awful lot of people talk to. No one is going to decline you a mortgage if you have a tenner on the Grand National. But if you are betting on a regular basis, let's say, call it 50, 60 euros per week, that's actually assessed as a financial commitment. So we're now assessing you for a financial commitment, maybe at 100 euros per month. So that can, I suppose, go against your mortgage application. But once you're operating, as I say, inside the terms and conditions, you're not living in your overdraft facility, that you're not living out of your savings, that your accounts aren't, I suppose, decreasing in the value month on month, there should be no issues in getting a mortgage application. And I suppose, Carol, not to tout a broker, but a bank will do the same. Someone that understands mortgages is there to help you. Like, I suppose if anyone came to me for a mortgage, my first thing is, okay, if you're not ready today, we'll get you ready. You know what I mean? It's about working with the person. And again, going back to that point, making sure that it's comfortable and they understand it and all the rest of it. But I suppose, okay, box ticked on the mortgage application and you get yourself approved. The next biggest step actually is finding the property. And I suppose we now know that that's an issue, but it's probably the most important part of the mortgage journey, because this could be your forever home. So it needs to be right.
There's a couple of things in what you've said there that I do want to break down, particularly maybe to give some special guidance to those who are currently living abroad and thinking of returning home, and also for those who are interested in self-build. But you touched on something really important there that I do want to get a little bit more information around, and that's getting people mortgage ready. So, before we came on air, you and I discussed really that, talking about our personal finances, it's still not something that we do. And I know, you had mentioned that, maybe it's still a bit of a taboo, whereas I'm probably showing my dysfunction at having been self-employed during the crash, where it's not even a taboo to speak out loud. It's that I don't even like thinking about it, and so we have a weird relationship with our personal finance. And, just this morning, I was listening to Jess Kelly on News talk about the things that we, the subscriptions that we have, the small subscriptions that we have. I'm afraid to even look at mine, but I'm quite sure there's so many there that could be cut straight away. And it almost feels, even though I know it's something that would benefit me, it feels like a job that I almost don't even want to start. So, well, first of all, let's address maybe the human and the psychological side of getting comfortable with our personal finance. Is that changing? Or is the next generation going to be better than we were?
I actually think they're going to be worse, Carol, and I genuinely mean that. Like, I come from, prior to joining Mortgage Navigators, I worked with Bank of Ireland, and part of our remit was around financial well-being. And I can even speak for my own kids. I have 3 kids, and I can guarantee you they are useless with money. You know what I mean? Absolutely useless with money. And I'd be, fairly on them to be good with money, but they're not. And I'll tell you the reason they're not is that they don't handle cash. So they don't know the value of a tenner or the value of a 20. You know what I mean? They're tap, 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 tap. And we see that, some customers will come to me and they're, mid-30s, and they're like, oh my God, I'm mortified now because I'm tapping all the time. It doesn't make a difference, from a mortgage perspective, once you're managing your finances. And I suppose there is I suppose if I go back to, and we'll bring it back to customers. So to answer your question, are we creating financial well-being and financial literacy for the next generation? I think we have a lot of work to do, and I really mean that, a lot of work to do for financial literacy. But from a mortgage perspective, I suppose my advice to someone that is the 12 and 18 months out customer, and they're actually, I love speaking to someone that is half thinking, you know what I mean, half thinking about buying a house, because I'll put things in place to make them disciplined. So like I'd often say to customers, there's no point you coming to me and you've no demonstrated repayment ability and I telling you need to save €2,000 per month when you haven't been doing it, because I can guarantee you that €2,000 will go into a savings account and €1,900 will come out the next month. So you have to, it's like a habit, you're forming a habit. So like if you're trying to get to that €2,000 and you're doing nothing today, you start with 200, you increase to 300, you increase to 400, so that you're taking it out of your net disposable income really slowly, and you're adjusting to it really slowly. Because, and I'd often advise someone, if they were Bank of Ireland banked, open an account with the credit union, open an account with the post office, make it difficult for yourself to get to the money. Now, where there's a will, there's a way, but there's no point putting it into a demand deposit account that you can just transfer straight off, or opening a vault and Revolut and transferring it back and forth, because you'll do it, you know what I mean? So it's creating a habit, you know what I mean? And that's the number one bit of advice. But sometimes what can often happen, Carol, is that people will come to us and say, I'm after putting a €5,000 deposit on a property, and they're not meeting any criteria. And that's the worst conversation you can have, you know, so because you have to wait a minimum of that 6 months for a bank to assess if it's outside criteria.
Are there still people doing that? I mean, that's something that used to happen a decade ago, but I see buyers today, whether they're first-time buyers or they're those looking to trade up or down, they're much more savvy, they're much more knowledgeable about the marketplace. And I suppose we probably don't see what's happening behind the scenes. But I just wouldn't have thought there'd be too many people putting a booking deposit down on a house without even checking for mortgage, because actually even estate agents today, before they even show a property to a potential buyer or investor, they look to see proof of funds. They ask about the mortgage. You know, these are really important first steps. You know, the thing that I'm really taking away from our conversation today, Margaret, is that I think you've kind of demystified the process by saying, actually, there are only 3 bars that you have to hit. And if you hit those 3 bars, you get your mortgage to the amount that is appropriate for you, the stage of life you're at, the job that you have, the career that you have, the family situation that you have. And I think that in itself actually would be quite freeing for home buyers to know it.
Absolutely. And to engage, Carol, and I suppose that's, and I like a broken record, but engage. We don't charge for our services. So pick up the phone. You know what I mean? If you're not ready, you're not ready. We'll get you ready. But if you are ready, we'll get you approved. So like, you know, and I suppose, you know, most banks and most brokers at this stage have an online system where you upload your documents, you're prompted. We all have checklists that you tick off. It's quite easy, you know what I mean? Like if I had to call it out, we have to prove who you are. So proof of address and proof of ID. We may ask you to run a central credit register report, which is an ICB report, just to make sure there's nothing flagged there that we'd have to anticipate before we submit it. We need to review that you're sound financially. So 6 months current account statements, 12 months savings statements. If you've been living abroad, we need your bank statements for whilst you were abroad, and potentially a credit history report for abroad as well. And then we have to prove your income. So if you're PAYE, it's easy. HR complete a salary cert and your last 2 to 3 pay slips. If you're self-employed, slightly maybe a little bit trickier and probably a little bit more preparation is how I'll call it out, because we're looking at your last 3 years sets of accounts. And I suppose if I had to call out, Carol, for self-employed, especially limited companies and sole traders, you know, there's the ability to be very tax efficient, I suppose, on your accounts. But by being unduly tax efficient, you're reducing your income for assessment. So there is a little bit of preparation that might need to be done in advance of a mortgage application to make sure that the accounts that we're assessing are reflective of your true income, I suppose, is the thing. And
but for people, sorry, Mark, for people who are self-employed, is it still 3 years? Because we're seeing, not just in Ireland, but globally, there's this move towards kind of the gig economy, move towards contractors. So so yes, technically it's self-employed, but you're not
Yeah.
self-employed in the way that we used to imagine people being
Yes.
self-employed. You're long-term contractors to the same company, earning usually
Yeah.
slightly above a salary. So actually, have there been mortgage considerations to reflect the changes that we're seeing in employment trends? Not just again in
Yeah,
Ireland, but globally.
yes is the answer to that, and I suppose Mortgage Navigators has come about. Carol, I don't know if you're familiar with that, but we've come about through Contracting Plus, which is an accountancy and payroll for contractors. So I suppose that's my bread and butter. I suppose if I to call it out is the professional contractor, and that's what we're good at. And I suppose when we came to market, we were coming to market so with the niche of that vast majority of our applications would be contractors, even though we're open to the full market. So we've sat down with the lenders. We have discussed how we will submit our mortgage applications and our credit papers to ensure we get those professional contractors through easily. And I suppose, look, there is a taboo because what often happened was that professional contractor presented to a bank and the person they met didn't know if they were self-employed or a PAYE because they have pay slips, you know what I mean? They're working for a company, but they're actually self-employed. You know what I mean? In a bank's world, they're self-employed. So what we need for that applicant, Carol, is if it's someone that's coming out of PAYE and is starting a professional contract for the first time, banks will actually assess them as the PAYE. So whilst their salary as a professional contractor has the potential to be more, they will still assess them from a mortgage application on their PAYE salary. Because worst case scenario is that they go back to PAYE. So I suppose the word or description I always use for professional contractors or self-employed is that we have to ensure and that we present that the income is sustainable. That regardless if this contract is 700 euros per day, if they were on 500 euros, we have to average it out. So what we'd normally do is that a long-term self-employed or a long-term contractor is that we're looking back at them if we can 3 years, but banks will accept them over to 2, right? Okay. But they're also looking at the contract in hand. So like, let's say it was 2022, 100,000, 2023, 110,000. What's 2024 going to bring? So now we're looking at the contract and we're annualizing what's expected of that contract from an income perspective. And we're trying to show that it's sustainable and consistent. So then the risk is taken away.
Is that difficult when you're taking a 3-year period and we have just come out of COVID during those 3 years? So actually for a lot of people in contracting, that might have skewed. So they might have 2 years of good performance or a year of good performance, a year a year of low performance, and then 2 years good performance. Is that averaged out?
It is. So what you do in that case, because everyone knows COVID existed, right? So if that person was self-employed back in 2019, right, we're trying to find the base year, right? Okay, so whilst we won't average it back to 19, we're trying to show the bank that actually 2022 and 2023 are actually a reflective year of consistency. Bear in mind 2020, 2021, there's a dip, but the dip is due to COVID. And bear in mind, the banks are reasonable, you know what I mean? And you can, I suppose, negotiate with them to a certain degree once you can prove, as I say, that it's sustainable is probably the biggest thing, because as we said about the first time buyer, this is potentially a 30-year contract or a 30-year financial commitment. So whilst the contract might be earning 150,000 this year as a contractor on their contract, their PAYE was 70,000. So like, even from their own perspective, what happens if they don't get that 150,000 contract again in year 2 or in year 3? So look, it's protecting everyone. Obviously the banks are out to protect themselves, you know what I mean, and I suppose have responsible lending and all of that sort of good stuff, Carol, but customers also need to protect themselves, you know what I mean? There's no point I saying, oh yeah, fine, you're passing 500,000 and they knowing that the applicant number 2 may not be working in 2 or 3 years time, because they're going to be under financial pressure is the
Yeah, so I like that you bring this back to really quite a common sense approach. I'm conscious of time, but there's 2 things I just really want to run through with you, and that is for those living abroad. How receptive are the banks to those living abroad, working abroad, but intending at some point to come back to Ireland?
Yeah. So the good news is that we have a product, because there was a time that we didn't have a product and we now have a product. Not all lenders have a product. So, we are, I suppose, there's two or three lenders that will consider it. The terms and conditions of the assessment is slightly different, Carol. So first-time buyer here in Ireland can borrow 90%. First-time buyer living in Dubai looking to come home can borrow 70%. So that can often be the number one stumbling block, right? Okay, so let's say you're buying a house for 400,000, you need 120,000 sitting inside in a bank account, and demonstrated that it's sitting inside in a bank account. What we're assessing is your income when you're living abroad. So again, a person living in Dubai, let's say a doctor living in Dubai or a teacher living in Dubai. We're assessing the income, so it's 4 times income. So the same Central Bank of Ireland rules apply. So 4 times income, the same net disposable income, the demonstrated repayment ability, all of those assessments are still the same, except we're assessing it in the home country. If there is a currency fluctuation, which more than often there is, we are deducting a stress test on the currency by 20%. And furthermore, what we're doing then is we're looking at, if this person comes back to Ireland, what will that income be? What will be their job? Can we prove that their income will be sustainable in Ireland? And that's quite easy to do, you know what I mean? Because we have plenty of pay scales available to us. The one thing we have to prove is that the person has a connection to Ireland and is, how will I put this, has the ability to be a resident in Ireland, so that there's no work permits or work visas required. And we have to prove that. That's probably the biggest paragraph we'll write in a credit paper, that, Mary Murphy is looking to move home. Her family has been living in whatever, Dublin for the last 30 years, so on and so forth. So there is a product. It's not perfect. The good news is that you can borrow at the private dwelling house rates that are currently available. So if it's a green property, they can get 3.65%. But I suppose the one thing to call out, Carol, is that this is not an investment product. So you're not buying the property for future rental income on it. You're buying the property as your future private dwelling house.
Okay, and look, again, I think that makes sense, and it would suit the people who are coming, who are genuinely planning to come home. I suppose final question there is around you touched on it there, those who are looking to self-build, because this is something that was problematic in the past, has become much easier, and then. But, certainly in the post-crash years, banks did not like dealing with stage payments and that. So what's the situation now for self-builds? Because there's still a fundamentally important part of delivery in Ireland. I mean, you touched on the fact that, there will be close to 30,000 new homes. It looks like the final figure will be for 2023. But we know that about 1/6 of those are self-builds. So it's a really important sector of the market. So what's the mortgage application like for those people?
Yeah. So there's only 1 or 2 differences. I suppose I'll go to differences rather than calling out all the standard assessment criteria. The number one is that if you've inherited a site, which predominantly is the case, you need a 10% contingency fund for overruns, right? So you can borrow 90% of the build cost, right? Or the value. Sometimes what we're seeing, unfortunately, in more rural parts, is that it's costing more to build the house than what the house will be valued at the end, right? Okay, so and that's important to call out, because people come to us and saying it's costing me 450,000 to build my house, but actually at the end the house might only be valued at 400,000, so the bank will only lend on the 400,000. So we look for a 10% contingency fund, and again, that's there to protect the customer rather than the bank, because we did see, unfortunately, over the last 2 years that the cost of inflation on building materials increased by over 30%, and actually left a lot of my customers quite vulnerable, to the point where they weren't able to complete the house to what they had anticipated that it would be. So 10% contingency fund is number one. You need an engineer to draw down your stage payments. So a self-build is on stage payments. So it's nearly like a chicken and egg, right? Okay, you build, bank pays, you build, bank pays. So you need your deposit. You know what I mean? The deposit is quite important, just in case the builder in between the stage payment comes looking for cash. So that's the best way to describe it. The end stage payment, Carol, again, is one that's different because the engineer has to go in and sign off the property that it has been built in compliance with the planning permission, the original planning permission. And no funds are issued until that is received at the very end. So it's quite a different process in ways, right? Okay. But again, very, very doable. Like, I suppose, to go back to the point there, it's getting the planning permission may be the challenge, and furthermore, getting the builder is now becoming a challenge. And you know, I had a call last week with a client, and they were saying, will we go direct labor or will we go with a full construction company to come in? And my advice was, go with the construction company and get it done. Because what happens is the letter of offer stays valid for 18 months with a bank on a self-build application. So if that property isn't completed in the 18-month period, it's actually a full mortgage application. And we all know that has something you only want to go through once or twice in your lifetime.
Yeah, absolutely. Actually, so the 18 months, that facility only being there for 18 months, that's actually would certainly point people down the direction of appointing a main contractor there, because actually it's very difficult to bring in your self-labour and get everything delivered and signed off in that period of time. And we haven't even touched off things like planning, but I think that's maybe a larger conversation for another day. But we know we are still waiting for the Department of Housing to issue guidelines to the local authorities on rural self-builds. I mean, it's been such a contentious topic. The guidelines, they were due a decade ago, but we were promised them almost 2 years ago. It looked like we might have them at the end of 2023, and we still don't have them now. So I think the future is less than certain for our rural self-builds.
I think so. Yeah.
However, it is such an important part of not just our housing market, but actually it's such an important part of our society and
absolutely, and keeping our towns and countries alive actually is the thing.
Absolutely. And I think, look, I feel like the rural conversation is only starting to happen post-COVID. You know, we've seen more people choose rural Ireland, and that's starting a really interesting conversation. But our facilities, whether it's planning or mortgages, and even infrastructure in terms of business and employment, has yet to I suppose, rise up to meet that ongoing conversation. And we don't know what form it'll take, but I think it's a really exciting time for rural Ireland, and I hope we use the opportunity that we're presented with now, because we have a time
to reinvigorate. Yeah, absolutely. We have time to reinvigorate. And you know, we've seen it. You know what I mean? Our small villages and towns, in some cases, can't field, let's call it, a football team, as simple as that. You know what I mean? And you have towns and villages coming together to get a football team together, and that's the heart of any small community, if I have to be honest.
Yes, but it's also a true reflection of Ireland, because you and I both have offices in Dublin. You also have an office in Cork. We've one in Galway. You're joining me from rural Cork. I'm joining you today, despite the backdrop, from rural Galway. So actually that is representative of modern life in Ireland, and we do need the National Development Plan is somewhat dated in this, and we do need policy to reflect the reality, and the reality is what people choose. So Margaret, thank you so much for being so generous with your time today. We might return to the issue of self-builds when those guidelines come out and we know a little bit more, and so we know what the demand in 2023 or 2024 and 2025 is likely to be. But for now, thank you so much. That was Margaret Barrett, Managing Director of Mortgage Navigators. My thanks to producer Katie Tallon and to the production team at Hear Me Roar Media. Also, huge thanks to our show sponsor daft.ie, Ireland's most visited property website. And thank you indeed for tuning in. We'll catch you on the next episode of the Property Roundup. In the meantime, please be sure to subscribe and to check out all of the other Irish and international real estate and construction shows here on iPropertyRadio.